According to the mainstream media, the US economy keeps getting better and better. It seems like there's no end. Just look at all of the economic data coming through. It's 100% perfect. Fantastic. Well, except for that one obvious fact. You came here for the truth, so let me unveil that for you. Today we're going to get into the real deal. You didn't come here for the mainstream media. You want to know what's really going on. So first I'm going to show you what they said, then we're going to look at reality. Let's begin by taking a look at this. Economy grows 3.2% in the first quarter. GDP shows and reports showing strength as well as short-term boost. This is fantastic. This news here was supposed to send the stock market higher, but we saw that some earnings reports came out that looked quite terrible, so that made it stay about flat. Now what you're looking at here, 3.2%, that bet all the estimations that they had. They thought it would be about 1% lower, yet it rockets higher. I mean, the economy is doing really well, right? Well, it's not so black and white. Look at this here. As you can see, the US quarterly GDP, it's showing you in the red on the right hand side what has happened. Now it had declined for a few quarters in a row. Now it's picked back up. This number here is incredibly manipulated, as we have seen time and time again. There has never been an instance at which this number represented the true economy of the United States, but this applies all around the world. The GDP number is not a fact. When you look at what they're able to include, it really skews things. For example, the introduction of Obamacare, when that came in, the GDP numbers, I believe, were at 5% when they first reported them, probably revised downward after that. But why? Because people had to spend more money on Obamacare. So it made the economy look good, but it's really just people spending. And it's not something that they necessarily were buying cars and buying phones and houses. No, they were buying their healthcare. They were forced into it, or else they would have to pay the taxes and so on. This is what we can see that has happened over time. And of course, in Europe, let's not even get started about the way that they're able to calculate it there. Quarterly GDP by component breakdown. So the GDP obviously is a measure of many things. You could see it at the bottom. They show you a legend, and you're looking at the personal consumption expenditures, the exports, and so on. And all of that is broken down. I just wanted to show you exactly what it is. And this gives you a better idea, because maybe one month you could have really good exports, but your imports are really bad, and the other way around. And you could see the strong dollar here hasn't necessarily affected it too much. That was a problem in previous instances, but you need to compare it to previous quarters, okay? You don't want to just use dollar terms, because different size economies, you have different amounts of imports and exports per country. Look at it on a quarter-to-quarter basis to give you an idea, and this just shows you here what is all breaking down into. If you've been watching this channel for a while, you know that I have a sense of humor. White House economic advisor Larry Kudlow says Fed should still cut rates despite 3.2% GDP growth. And this is why I wanted to bring it to you, because we all need a good laugh. We all need to sit here among all of this negative news that comes out that I'm able to piece together that seems to be hidden out there. We have some humor. And I just want to thank Larry Kudlow for putting out this info, because it just helps us to give really a bright spot in our day. GDP grew by 3.2% in the first quarter. Kudlow called a blowout number. Fantastic. Economy is great, right? Well, the inflation rate continues to slip lower and lower. Kudlow said that the argument for cutting interest rates was coming by the Fed's own metrics. That's right. Look, the Federal Reserve said so, therefore we should do so. Now, looking at this very carefully, what do we have? We have statistics over and over that they show us, like the GDP, that have been doing very well. Then you look at the inflation rate, whether we're looking at the core PCE, that's approximately 1.8 or 1.9 the last time I checked, showing you that it is under their supposed 2% inflation rate target. Let's think about this for a moment. Why do they need 2% inflation. What would be the problem with having 1.5% inflation? Is there a real issue there? Is that a real concern that inflation is not going to eat out so much of those people's hard-earned dollars? Is that really a problem? When you think about it, the reason that they do these things, the reason that they print money and reduce interest rates isn't what they're telling you. It's not in order to create prosperity or something. That's ridiculous. This creates bubbles. They love bubbles. Don't ever let them think that that's not what they want. They want to create a bubble. They want to create a crisis so then they can pose as the saviors when they come with the predetermined solution. How many times do we have to see these cycles? But it's only those who are students of history that will ultimately understand this. If you are one person who actually cares, you are a student. There are so many people out there who think they know it all. Me, I don't know much. What I do know is that I want to study, and study. I want to learn as much as I can. I am a student of history and I read about it every single day. There are so many books written about all of the major events that have taken place in history, so many about 1929, but what really led up to 1929? Don't just study the charts. Don't look at the 200-day moving averages. Read all of the data that goes along with that. What about all the derivatives and how they started getting created? Where did that really come from? Well, one of the best books written about that, I think I have it in my my link in the description under my favorite books, Frank Partnoy, who is really, I've never heard of anybody talk about this book, and I consistently mention it because you will learn so much. Infectious Greed. This book is fantastic. I've had subscribers tell me after I've recommended it that it was incredible to read. Infectious Greed by Frank Partnoy goes through and basically tells you how all of the games that they play, how they're able to manipulate these statistics and their whole, they come out every quarter, they're telling you that one number is great and one number is great. They can do this. Corporations and governments can come out and give any number now by indefinitely postponing results until later. They are able to do this because they manipulate. They are able to use the accounting and things that you and I, that would be illegal for us to do, but they can do whatever the hell they want. They're above the law. They're above any regulations. And this is what we're dealing with today. Okay, so let me move on to what I think is so important, the Fed funds rate. This is the Fed funds rate. You're looking at it. It's actually 2.44 right now. This number hasn't been updated since April 1st. We're looking at it at 2.44. It's coming up to the highest end of that bracket that they have between 2.25 and 2.5. I just wanted to show you the fact that this is the slowest they've ever increased ever, as far as I'm aware. I mean, just look at the pace at which they did this. They brought it up in December of 2015. They kept it here at this long stretch. Then they started to increase slowly but surely. It's been increasing. And all the while, we've been hearing about this being too tight. It's too tight. It's too restrictive. The banking system can't handle it. The financial system needs more easy money. But the economy is doing great. All right. So right now we are at less than 2.5% on the Fed funds rate. At the same time, we're getting these GDP numbers that are coming up looking so great. Look at what happened last time. 2004, we hit the bottom of 1% of interest rates, and it climbed up all the way. They went up steadily from 1% to over 5% in a period of, let's say, 2 years, I'd say. So within a 2-year period, last time around, end of 2015, look at where we are today. Years and years just to get it up a couple percent. It's barely struggling at this point, but look at this. Look at what occurs. Every single time they bring it to this level and they cannot get it to go any further. So they keep it here and it lasts. It depends on the cycle, of course. I believe the previous time was much shorter than this. This one happens to be longer, but it's always too late. And then they have to hurry up and drop interest rates dramatically, and it has to go lower than where it did previously. Okay, so it was at 1% lower, and then, as you know, they dropped it down to the floor. So what we could see is actually interest rates dropping down into the negative territory. Many have argued that this is the best thing to do even right now. You're seeing this coming out of every single place, whether it's the Federal Reserve itself, whether you're hearing analysts talking about it. This is the way that you stimulate. Of course, there is no country today that has put interest rates into the negative that has actually commended them, but they're kind of trapped, they're kind of stuck because they can't increase. None of these countries have actually done well because of negative interest rates, but here we go. We're probably going to head into that territory anyway, and we're going to see the expansion of the balance sheet. Nobody seems to care. So this is what's real. It's that when you look at the Fed funds rate, when you look at what interest rates are set to today, it's so far off from what these statistics they're showing us. You're not representing the truth by this what you give us. It's ridiculous. Okay, just a couple quick ones here. Walmart and Target shares tumble as Amazon announces one-day shipping for Prime members. I'm looking at this particular company to wipe out so many others. If they can't keep up, this is the way it goes. So the reason I'm mentioning this is basically that you have certain companies that are going to disrupt entire industries. So a company that's been there for 20 years, 30 years, 40 years that has done very well may not necessarily be the case. And what happens is that in the next cycle, so when you have stocks falling dramatically in this next cycle, those that rise from it may not be the ones that you're used to. That's the reason I mentioned this. That's why I talk about this often. It's that when there are cycles, you think, well, don't worry about it because my stock is just going to go back up eventually. It's not always the case. Look at what's happening with these big industries. Look at retail. It's being absolutely demolished. And this has been happening at a time when we've seen stocks rise to new highs. So it's not always the companies you necessarily have been used to. Daimler hurt by production delays at Mercedes, and China's slowdown, of course, is impacting this. You could see Mercedes-Benz sales in China, the world's largest car market, fell 3%, and so on. It goes in to show you sales of Mercedes-Benz cars fell 7% in the first quarter. To talk about the details there, I just wanted to make that known. And then this, China's passenger vehicle sales year over year change, moving well into the negative. This has been a very big effect globally, of course, because China's importing everything. China's exporting everything as well. They're a big market. They're the biggest consumer of basically, half of the products out there that are in existence, whether it's cars or cell phones or anything else. So what happens there is usually an indicator of what could happen elsewhere. They're printing a lot of money and it's not doing much. This is just showing you the car sales. Here, European Automobile Manufacturers Association provided that details. It is in the negative as well. This is something I need to get through. Here we are talking about stock buybacks. You know how important these are. I've covered this so many times before. No other asset globally is hated as European equities are, but according to Sanford Bernstein strategists, the region's stocks have one big advantage that could attract U.S. investors over the next 12 months. U.S. stocks will lose the major support they got from buybacks as a deterioration in the quality of corporate debt and slowing economic growth put an end to share repurchases bonanza that reached $1 trillion in 2018. Now that's according to them, and the reason I'm bringing this up to you is that we have seen record buybacks taking place so far in 2019, so I'm not sure that this is going to be the case. If we have a lot of money, as we see, that's sitting on the sidelines, as they say, in cash, although I don't agree with that term, this could go into U.S. equities, it could go into real estate, it could go into anything. But that money is basically sitting there because they're worried, they're concerned. You're looking at the GDP numbers that just came out. Could that be beneficial for the U.S.? Well, at the same time, as they mentioned here, corporate debt is looking very bad. And it's not just in the United States, of course, it's globally. Globally, we've had this problem of corporate debt, and it has been expanding. We've seen all the BBB rated debt that is, in fact, ready to, explode on us. But anyway, this is something that I just wanted to show you because if in fact this is true in the way it goes, yes, obviously this is going to be negative for US equities, but so far this year we haven't seen anything of the sort. We've seen massive buybacks going on. I can't wait to get the numbers for April and see what happened because this was supposed to be something very huge this month around. Where are the buyers that have been buying into these stocks right now? I'm really curious to find out. So when I get those numbers for you, I definitely will provide a video. That's all for this video. If you found it informative, informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. If you want the financial education you weren't taught in school, then you got to read these 2 books, everything you need in the description. If you want the audiobook, that's available at themoneygps.com. One of the numbers that they always bring up is the unemployment rate. If you watch this video, I will explain in detail why the unemployment rate is a fake, false number.